If you had to name one individual who stands as both a trading legend and the teacher behind legendary traders, there is really only one name that fits that description: William J. O'Neill. To understand O'Neill's true influence on the stock market, we don't actually need to spend much time talking about him directly. Instead, we can look at the results produced by the traders who learned from his work, his research, and his philosophy. The first is Dan Zanger, a trader who holds one of the most remarkable records in modern market history, turning $10,000 into $42 million in just 23 months. The second is Mark Minervini, a two-time U.S. Investing Championship winner who grew a $30,000 account into more than $72 million and later documented his approach in two books that have become essential reading for serious traders worldwide: Trade Like a Stock Market Wizard and Think and Trade Like a Champion. The third is David Ryan, a trader who achieved something that has never been repeated, winning the U.S. Investing Championship 3 consecutive years, from 1985 to 1987. These three names are not isolated success stories. They represent consistent, repeatable results achieved across different market environments, and together they form living evidence of the effectiveness and durability of the trading principles William O'Neill developed.
And in reality, O'Neill's impact extends far beyond these well-known examples. Through his research, his books, and his timeless market principles, William O'Neill has influenced millions of traders worldwide, shaping how generations of investors think about growth stocks, market cycles, risk, and opportunity. In today's video, we're going to break this legacy down into two core components. First, we'll analyze William O'Neill's trading methodology, how he selected stocks, how he interpreted price and volume behavior, and the real meaning behind the classic chart patterns he repeatedly relied on. Second, we'll examine the foundational principles that made his approach successful, principles that have remained relevant for decades regardless of how much the market has changed. This will be a long-form, in-depth video. If you stay until the end, it likely means you're serious about trading, and more importantly, that you're thinking in the right direction as a developing professional. You can treat this video as a deep trading podcast or as a complete, structured lecture on one of the most influential methodologies in market history. Part 1. William O'Neill's Trading Method. For traders who have spent enough time in the market, the name William O'Neill is almost automatically linked to Canslim. But Canslim was never meant to be just a stock screening checklist. It is a complete decision-making framework built from William O'Neill's systematic study of tens of thousands of winning stocks spanning more than a century of U.S. stock market history. This research was not theoretical, it was empirical. O'Neill didn't start with opinions or market predictions. He started with results and then worked backward to identify the common traits shared by the biggest winners. Over decades of analysis, one pattern became clear. Stocks that produced the largest gains were not random, and they were not evenly distributed across the market. They consistently shared a specific set of characteristics in their fundamentals, in their price behavior, and in the broader market environment in which they advanced. Canslim is the distilled outcome of that research. Each of the 7 letters represents a necessary condition, not a suggestion, designed to identify stocks with the highest probability of becoming leaders during major bull market cycles. The system was never designed to find average opportunities. It was designed to find exceptional stocks at the right time in the right market context. Let's break it down, not mechanically, but conceptually, to understand why this system still works today. The first element in Canslim is C, current quarterly earnings, which refers to the growth of a company's most recent quarterly profits.
William O'Neill focused on businesses that delivered strong, accelerating quarterly earnings growth, typically at least 25 to 30% higher than the same quarter a year earlier, and ideally sustained across multiple consecutive quarters. This was not an arbitrary threshold. Through historical research, O'Neill found that the market's biggest winners almost always showed meaningful earnings acceleration before their major price advances began. In O'Neill's view, smart money does not chase vague narratives or distant promises. It responds to real, measurable improvement, expressed clearly in the numbers. Quarterly earnings represent the earliest and most direct evidence that a company is performing better than it did in the past. This is also where large institutional investors begin to pay attention. Long before a story becomes widely accepted by the public, earnings growth signals that something inside the business has already changed. For O'Neill, current quarterly earnings were not just a fundamental metric, they were an early confirmation that demand for the stock was likely to follow.
However, a few impressive quarters are not enough. That is why A, annual earnings growth, serves as the second foundational pillar in William O'Neill's system. O'Neill looked for companies with consistent annual earnings growth, typically averaging around 30 to 50% over multiple years. Through extensive historical research, he observed that the greatest stock winners of all time already possessed superior long-term earnings records before their prices truly exploded. The purpose of the A criterion was never to search for safety, but to eliminate mediocrity, companies with sluggish profits, erratic earnings cycles, or weak profit margins. A business that has delivered steady earnings growth over many years does not guarantee a perfect future. However, the probability that a company already performing well will continue to perform well is significantly higher than that of a company with a poor or unstable earnings history. More importantly, the A factor builds confidence for institutional capital. Large funds cannot move in and out of positions quickly. They require a credible, multi-year growth story to justify meaningful commitments. Without strong annual earnings growth, a stock may still rally in the short term, but it becomes extremely difficult for it to develop a powerful and sustainable long-term uptrend.
The third element is N, new, which represents something new. William O'Neill famously stated, almost all big winning stocks had something new. New can take many forms: a new product, a new technology, a new service, new management, a new business strategy, or even something as simple as a stock breaking out to new all-time highs. In O'Neill's framework, new price highs often reflect meaningful changes taking place inside the business, sometimes before those changes are fully visible in financial statements. The market does not buy the past, it buys expectations about the future. Stocks with a compelling new story, and more importantly, stocks that prove that story through real earnings growth, often become true superperformers. A clear example of the N, new principle is NVIDIA, when the market began to anticipate that the company would dominate an entirely new business segment, AI chips. Initially, this was simply a future-oriented narrative. Over time, however, that narrative was confirmed by actual results, as NVIDIA's earnings grew consistently year after year. It was this transition from expectation to verified earnings growth that turned NVIDIA into one of the most profitable stocks in the market over recent years. A similar logic applies to Tesla, a classic example of a company built around a transformative new idea, electric vehicles. In its early stages, the market bought Tesla primarily for its vision and long-term expectations. However, it was only after the company began generating profits and demonstrated that the EV story could translate into real financial growth that Tesla's stock entered its explosive phase. As a result, between 1919 and 2021, Tesla's share price rose by more than 3,000%, becoming one of the most powerful market moves of the modern era. Many historical examples followed the same pattern. Microsoft, first with Windows and later with Intelligent Cloud, and Apple with the iPhone, all shared a common trait, a genuinely disruptive new element. The common denominator was never the story itself, but the fact that the new factor was validated by sustained earnings growth. In line with O'Neill's philosophy, when new is confirmed by profits, the market revalues the business, and that revaluation is precisely when these stocks enter their most powerful long-term advances.
The fourth condition is S, supply and demand, the core principle that William O'Neill repeatedly emphasized. The law of supply and demand governs stock prices just as it does everything else. The strongest stock advances in history have typically occurred in companies with a relatively limited number of shares outstanding, minimal dilution, and, most importantly, a sharp expansion in trading volume when prices break out. O'Neill did not treat volume as a secondary indicator. He viewed it as direct objective evidence of demand. According to O'Neill, big winning stocks usually move through two distinct phases. The first is an accumulation phase, during which price moves sideways while trading volume gradually contracts, signaling that selling pressure is drying up as available supply becomes exhausted. The second is the breakout phase, when price pushes above the base with volume expanding at least 40 to 50% above average, confirming that demand has decisively overwhelmed supply. If a stock rises without volume, O'Neill considered that move false demand. Breakouts that occur without strong volume support tend to fail quickly. Institutional capital never operates in complete secrecy. It always leaves footprints in the market, and those footprints are visible through the interaction of price, volume, supply, and demand. The fifth element in the Canslim system is L, leader or laggard, and it is also one of the most unforgiving filters in William O'Neill's entire methodology. He repeatedly emphasized a simple but powerful rule. You want to buy the leading stocks, not the laggards. Through the study of thousands of winning stocks across more than a century of market history, O'Neill identified a clear pattern. Nearly all stocks that went on to make major advances were leaders before they broke out, while lagging stocks rarely, if ever, became true super performers. As a result, the purpose of the L criterion is not to optimize returns across every stock, but to eliminate the vast majority of weak stocks at the very beginning. A critical point in O'Neill's approach is that he did not define leadership by company size or brand recognition. Leadership was defined entirely by price behavior. A stock is considered a leader when it outperforms the general market, outperforms its industry peers, recovers quickly from pullbacks, and consistently reaches new highs ahead of the rest. In other words, a leader is not a stock an investor likes. It is a stock that institutional capital has already chosen. Price action and relative strength serve as the most objective evidence of that selection. The L factor also reflects a harsh reality of the market. Most stocks never generate meaningful gains. In every bull market cycle, only a small group of stocks truly drives the major indexes higher, while the majority either move sideways or underperform the market. History has repeated this pattern many times. Decades ago, during cycles dominated by railroads, steel, and heavy industry, only a handful of names stood out. More recently, in the era of electric vehicles and artificial intelligence, only a small number of stocks have emerged as true leaders, while most others failed to keep pace. Canslim was never designed to distribute opportunity evenly. It was designed to concentrate capital in winners.
In practice, O'Neill applied the L criterion with clarity and discipline. He only looked for opportunities when the overall market was in an uptrend.
He then identified the strongest industry groups during that period and selected one or two of the most powerful leaders within those groups, completely ignoring the rest. O'Neill never diversified into weak stocks simply to fill out a portfolio. He also pointed out two common psychological mistakes made by many investors. The first is buying lagging stocks simply because they appear cheap. O'Neill rejected this logic directly. Cheap stocks are usually cheap for a reason. The second mistake is avoiding leading stocks because their prices seem too high. In O'Neill's view, high price does not equal high risk. High price combined with a proper base and strong price behavior is often where opportunity exists, because a stock that fails to build higher bases and break out to new highs will never generate the momentum required to become a true leader. Ultimately, O'Neill was not concerned with how high a stock had traded in the distant past. The only question that mattered was who is winning right now. Stocks that consistently reach new all-time highs are strong. Stocks that remain far below prior peaks for years, even if they look cheap, are rarely bargains. More often, they reflect serious underlying problems within the business, especially when other stocks in the same industry are moving to new highs, while that stock remains stuck at the bottom.
The sixth element is I, institutional sponsorship. William O'Neill believed that major price advances cannot develop without institutional capital. Large funds possess both the scale and the time horizon required to push stock prices significantly higher over the long term. When a stock is accumulated by institutions with strong performance records, it indicates that the company has passed through multiple layers of rigorous analysis and due diligence. While institutions are not always right, the presence of high-quality institutional sponsorship significantly increases the probability of success. In O'Neill's framework, institutional buying is not a guarantee, but it is a powerful confirmation that a stock has the fundamental and behavioral characteristics necessary to sustain a major uptrend. The final element is M, market direction, the factor that ultimately determines timing. William O'Neill's core thesis was very clear. Approximately 75% of stocks move in the same direction as the overall market. Selecting the right stock is not enough. You must also be right about when to act. In a rising market, the probability of successful breakouts is high. However, when the market is moving sideways or entering a distribution phase, breakouts tend to fail in clusters. The M factor does not evaluate the quality of a stock. Instead, it functions as a risk-on, risk-off switch, helping traders understand when to press aggressively and when to step back to preserve capital. In O'Neill's framework, market direction governs opportunity. When the market is supportive, even good setups work better. When it is not, discipline matters more than selection. The 7 elements of the Canslim filter answer only the first question in the trading process: which stocks to focus on. Together, they form a foundational screening framework designed to identify companies with strong growth characteristics, a compelling new factor, support from institutional capital, and alignment with the broader market trend. However, in William O'Neill's view, selecting the right stock was never sufficient. The most important and most difficult question has always been when to buy. O'Neill never bought stocks randomly or based on emotion. He understood that even the best companies can produce losses if purchased at the wrong time. For that reason, after a stock satisfied all the Canslim criteria, he waited for confirmation from price behavior. Specifically, O'Neill only bought stocks when they formed high-probability price patterns, such as the cup with handle, flat base, double bottom, or ascending base. The selection of these patterns was not arbitrary.
Through the study and analysis of thousands of super-performing stocks across more than a century of market history, O'Neill observed that these structures repeatedly appeared before major price advances, and, more importantly, they delivered significantly higher success rates than other setups. Each pattern is not merely a geometric price formation, it is a reflection of supply and demand, market psychology, and the accumulation process of institutional capital. In other words, behind every pattern lies a specific story and a specific logic, a narrative about who controls the stock and why price is approaching a new advancing phase. In the next section, we will break down each of these patterns individually to understand their structure, their underlying meaning, and how they are applied within O'Neill's methodology. The first pattern is the cup with handle. In William O'Neill's framework, this pattern is not merely a geometric price structure, but a necessary process of correction and reaccumulation that follows a strong prior advance. The left side of the cup typically begins with a decline that appears shortly after the stock has already experienced a significant price run. This pullback reflects natural profit-taking by short-term participants, along with selling pressure from early investors who want to lock in gains. According to O'Neill, this is a healthy market response because true market leaders rarely move straight up without pauses to absorb excess supply. As the selling pressure gradually weakens, the stock enters the bottom of the cup. This is the most critical phase of the entire pattern, where the downward momentum slows and price begins to trade within a narrower range. Trading volume during this phase typically contracts noticeably, indicating that aggressive selling has largely dried up and that sellers willing to exit at any price have already left the market. O'Neill viewed this phase as a transfer of shares from weak holders to more patient, longer-term buyers, including large institutions. Supply and demand gradually returned to balance, laying the groundwork for the next advance. Once excess supply has been absorbed, the stock begins its recovery phase, the right side of the cup. At this point, demand starts to gain the upper hand, allowing price to rise in a measured and controlled manner. One important characteristic of this recovery, according to O'Neill, is that price advances smoothly without an excessive surge in volume. Institutions typically accumulate shares strategically, avoiding sharp price spikes before the accumulation process is complete. As price approaches or returns to the prior high on the left side of the cup, the market is often not yet ready to break out. At that level, there is usually still a group of investors who were previously trapped and are waiting to sell near break-even. This residual supply causes price to pull back modestly once more, forming the handle. O'Neill described the handle as the final test of supply, where the remaining weak holders are shaken out. During this phase, price typically corrects lightly while volume dries up further, signaling that selling pressure is no longer aggressive. When the handle is completed and short-term supply has been fully cleared, the stock reaches a decisive moment. The proper buy point in a cup with handle occurs when price moves above the high of the handle with a strong expansion in volume relative to average. In line with O'Neill's principles, this breakout reflects a clear imbalance between supply and demand, as institutional buying decisively overwhelms the remaining shares available for sale. This is not a random price surge. It is the natural result of a long, controlled accumulation process, and it marks the potential beginning of a new and powerful advancing phase.
The second pattern that William O'Neill frequently used is the flat base. In O'Neill's approach, a flat base is not a random consolidation, but a clear expression of exceptional strength following a prior advance. The prerequisite for this pattern is that the stock has already experienced a distinct upward move.
Any stock that rises meaningfully will encounter profit-taking from investors who are sitting on gains. What distinguishes a true market leader, however, is that despite the emergence of selling pressure, price does not decline significantly. Instead, it moves sideways within a very narrow range. According to O'Neill, this behavior signals that demand remains dominant and that institutional capital is not allowing the stock to correct deeply. During the formation of a flat base, price trades quietly with limited volatility, while trading volume typically dries up. This reflects the fact that most short-term selling pressure has already been absorbed and that existing holders are no longer interested in selling at lower prices. O'Neill believed that the flatter and quieter the base, the higher its quality, because it indicates that the stock is being held tightly by confident, long-term investors, particularly large institutions. A critical point in O'Neill's method is that he did not buy stocks while they were moving sideways. A lack of price movement does not mean the buy point has arrived. Instead, he patiently waited until the process of supply absorption was complete and the temporary balance between supply and demand was broken in favor of buyers. That moment appears only when price moves above the top of the flat base with a decisive expansion in volume, signaling that demand has returned with conviction. In line with O'Neill's philosophy, the breakout from a flat base is not the start of a new trend, but the continuation of an already proven uptrend. A flat base functions like a necessary technical pause, a moment when a high-speed train briefly stops at a station to let passengers off and take new ones on, before continuing forward at even greater speed. Properly identifying a flat base helps investors avoid boarding the train too early while it is still idle, and at the same time ensures they are ready for the decisive moment when it begins to accelerate again.
The third pattern that William O'Neill frequently used is the double bottom. In O'Neill's framework, the double bottom is a story of supply being gradually exhausted through two tests. This pattern appears only after a sufficiently long downtrend, when the majority of investors have already lost confidence and sold their positions. The first decline ends at the initial bottom, where selling pressure explodes as panic takes hold. This is not a buy point, but rather a signal that a large amount of supply has been released. After that, price rebounds, not because the market suddenly believes the stock has turned positive, but because selling pressure temporarily dries up. This rebound forms an intermediate peak, which acts as a natural resistance level. When price turns down again, it breaks below the prior low to form the second bottom. The fact that the second bottom is lower than the first is not a negative signal. Instead, it represents a deliberate shakeout, forcing the remaining weak holders to sell. The critical difference in this second decline is that selling pressure is noticeably weaker. Volume is lower, and price no longer collapses in a free fall. This behavior indicates that supply has been largely absorbed. From the second bottom, price begins to rise in an orderly manner. Aggressive selling disappears, and pullbacks become shallow and brief. This is the phase when institutions start to build positions quietly, avoiding early price spikes. As price approaches the midpoint high between the two bottoms, the market reaches a decisive moment. If the stock breaks above this level with strong volume, it signals that all remaining supply at resistance has been overwhelmed by demand. According to O'Neill, this is the moment when the uptrend truly begins, and it is also the only valid buy point in the double bottom pattern. The logic of the double bottom is therefore straightforward. The first decline removes the panic-driven crowd, the second decline eliminates the remaining impatient holders, and the breakout confirms that there are no sellers left, while institutional demand begins to assert itself. Price advances not because of prediction, but because the balance between supply and demand has shifted.
The fourth pattern that William O'Neill frequently used is the ascending triangle.
In O'Neill's philosophy, this pattern is not viewed as a purely technical triangle, but as a temporary pause in the market designed to absorb supply after a prior advance. The ascending triangle only has meaning when it forms after a clear upward move, because O'Neill believed that the best bases are always consolidation areas that develop after a stock has already proven its strength. When price enters an ascending triangle, the market is no longer in the early stage of skepticism. Instead, it has moved into a phase of temporary balance between buyers and sellers. The horizontal resistance line of the ascending triangle reflects a very specific reality. At a certain price level, there remains a steady amount of supply willing to sell. This area often represents prior investors selling at break-even, or institutions taking short-term profits, causing price to be rejected repeatedly at the same level. According to O'Neill, however, the critical factor is not the rejection itself, but how price behaves after each rejection. If a stock were truly weak, it would break down sharply. In contrast, within an ascending triangle, pullbacks tend to be shallow and quickly bought. It is in these pullbacks that the true nature of the pattern is revealed. Each decline produces a higher low, showing that buyers are willing to accept increasingly higher prices. This behavior reflects a shift in market psychology. Investors, especially institutions, are no longer patient enough to wait for the lower prices that were available before, because they believe the stock still has meaningful upside ahead. According to O'Neill, this is a defining characteristic of accumulation. Large capital is quietly buying shares while preventing deep declines in order to avoid drawing attention too early. Throughout the formation of the triangle, trading volume typically contracts. This signals that selling pressure is gradually weakening. Those who wanted to sell have largely done so, while the remaining holders are increasingly tight with their shares. O'Neill placed special emphasis on the idea that a good base is a quiet base, one without panic and without excessive excitement. The narrowing price range, accompanied by low volume, reflects a temporary equilibrium before a new imbalance emerges. When most of the supply at the horizontal resistance level has been absorbed, only a modest increase in demand is required to break that balance. That moment arrives when price breaks above the resistance line with a strong expansion in volume. In O'Neill's view, this breakout is not the start of a new uptrend, but the continuation of a trend that has already been prepared. The heavy volume at the breakout confirms that institutions are now forced to buy at higher prices because there are no longer enough shares being offered at lower levels. In summary, the ascending triangle is a story of rising demand confronting fixed supply until that supply is exhausted. The pattern reflects a process of quiet institutional accumulation, controlled price behavior that prevents deep declines, and a final push through resistance when conditions are ripe. In line with O'Neill's philosophy, the power of the ascending triangle lies not in its shape, but in the price and volume behavior that reveals who controls the stock and how much they are willing to pay.
This is the complete picture of the Canslim methodology. At first glance, the system can appear lengthy and somewhat complex, as it consists of multiple conditions and principles. However, once the core logic is understood, it becomes clear that Canslim is actually a very simple yet highly effective system. The essence of Canslim does not lie in technical indicators or complex analysis, but in identifying the right type of stock. These are companies with superior growth characteristics or businesses that possess genuinely transformative new factors capable of driving meaningful change in the future. Only stocks with these qualities have the potential to generate powerful and sustained price advances, attract large institutional capital, and emerge as leaders within a market cycle. Once the right stock has been identified, the remaining task is not prediction or speculation, but patience and timing. O'Neill did not attempt to forecast market tops or bottoms, nor did he buy based on emotion.
Instead, he waited for stocks to confirm proper buy points through classic price patterns that have repeatedly demonstrated high success rates throughout market history, such as the cup with handle, flat base, double bottom, and ascending triangle. Each of these patterns tells the same underlying story. Supply has been absorbed, demand is beginning to dominate, and price is preparing to enter a new advancing phase. Importantly, Canslim does not rely on complex mathematical models, statistical formulas, or future projections. It is built on fundamental and enduring principles: earnings growth or meaningful innovation, supply and demand, price strength, and overall market direction. This simplicity of thought, combined with disciplined execution, is what has allowed Canslim to endure and prove its effectiveness over multiple decades. In short, Canslim is both simple and powerful, offering traders a clear roadmap: select the right stocks, wait for the right moment, and allow the market to do the rest.
Part 2. The principles behind the method. Once the right leading stock has been selected and the proper buy point has been identified, everything that follows, and this is the core reason William O'Neill's method has remained effective across market cycles, ultimately revolves around two principles: discipline in cutting losses and the ability to hold winners. O'Neill condensed this entire philosophy into a single well-known statement: the whole secret to winning in the stock market is to lose the least amount possible when you're not right. You cannot achieve sustainable success in the market unless you first know how to protect capital. In any probabilistic game, survival is always the prerequisite before victory. For this reason, O'Neill placed extraordinary emphasis on cutting losses quickly and decisively. When you buy a stock and price moves against you, it means the timing was wrong. Accepting that mistake and exiting early is not a failure, it is an act of capital preservation. By contrast, O'Neill regarded averaging down as one of the most dangerous mistakes an investor can make. Averaging down is like a general repeatedly sending troops into a battle that is already lost, hoping the situation will somehow reverse. In the market, hope is not a strategy. However, cutting losses quickly only helps you avoid losing. It is not enough to ensure success. To truly win, an investor must master a far more difficult skill: holding winners for long periods of time. Many traders are correct in their stock selection and entry timing, yet still fail because they take profits too early. Capturing small gains during a major uptrend will never create meaningful long-term wealth. According to O'Neill, once the right leading stock has been chosen and the trend remains supportive, the investor's job is to allow profits to develop freely. A typical approach is to manage gains using price structure. Each time the stock forms a new base and breaks out successfully, the investor raises the protective stop to the low of that base. In doing so, profits are gradually locked in while still allowing the stock to continue higher as long as the trend remains intact. In summary, within William O'Neill's method, cutting losses quickly allows you to survive, while holding winners correctly allows you to win. When these two principles are applied with discipline and consistency, Canslim stops being a theoretical framework and becomes a practical, battle-tested method capable of guiding investors through multiple market cycles.
If you've been struggling in the market, jumping from strategy to strategy, watching profits disappear, and still feeling unsure about what actually works, then the trading program I'm running right now was built for you. On the screen in front of you, you're seeing the real results of my students. Many of them have become consistently profitable, passed funding challenges, and now manage capital with confidence and discipline. In the past, students paid thousands of dollars to attend this training in person, but today, I'm making the entire program available almost completely free. You only pay $25. That $25 is not tuition, it's commitment.
To be completely transparent, after YouTube's 30% cut and taxes, I barely receive anything. But I didn't make it free for one simple reason. When something costs nothing, people don't take it seriously. When there's even a small cost, they show up, stay consistent, and actually do the work. $25 is the price of a couple of Starbucks drinks, yet it could save you years of trial and error and potentially tens or even hundreds of thousands of dollars in trading losses. I've opened the door. The only question now is, will you take it? You can join through the YouTube membership program or click the link in the video description.